So now value gaps, they come in all shapes and sizes. They can occur one at a time. They can occur all at once in major market downturns. It happens in all industries, all sectors. It's for this reason that Arnold started, when he started the firm in 1974, that he adopted an all-cap strategy so that we weren't limited to cap size. We could go wherever the value was, and we weren't limited by industry. So wherever the value is, big or small, this industry or that, we're looking at capturing value gaps no matter where they are. Relative to the index, our portfolio has a smaller cap tilt to it. Now, that's not the first time in history that happens. It's been often the case throughout history, and the reason is pretty simple. Small cap stocks are more volatile over time, and that movement means that small caps hit our buy points more often over time than big cap stocks do. So naturally, if smaller companies are hitting our buy points more often than big cap companies, they're going to be a bigger part of our portfolio. And it's a good thing because small caps have a bigger reward to risk ratio than big cap stocks do. And by doing so, they've been a bigger part of our portfolio and been major contributors to the performance over time. Now, the recent push that we've had for market participants to avoid this volatility has been pushing them into the big cap dividend-paying stocks, which we saw in the index review. This is creating voids throughout the rest of the marketplace, and in one area that we see in particular is the small companies. So as Arnold said, and Steve mentioned in his discussion, we think there's a lot of opportunities in the small cap world going forward, and the environment is starting to get ripe for that. However, even after this discussion, you still may be a little uncomfortable with the volatility in small cap stocks, but that's okay. You'll get comfortable with it, I assure you. If not, I'll just come back talking till you are. But anyways, so last year we developed and opened up a small cap mutual fund that's dedicated to small cap stocks called the SEMA Advisors Small Cap Value Fund. But we did this, we started the fund so that we could offer the performance that small cap stocks have to our clients, but doing it with increased diversification that just isn't possible in an individual account. So for example, in a typical individual account, we might be able to buy 10 to 30 small cap names. In the small cap mutual fund, we can buy 60 to 90 names. So there is increased diversification in the fund. But there's some additional benefits to having a fund format. One, we can buy companies that have much smaller float, which makes it impractical for us to buy and equally distribute amongst all the client base. So we can buy those in the fund. And the fund format also has increased benefits of scale, which allows us to accumulate in smaller percentage increments without additional commission costs. I know how sensitive everybody is for commission costs. We also have access to a much broader range of brokerage firms. All of you have your individual account at one broker, and that's predominantly where all the trades are done. From the fund, we can buy stocks across 15 different brokerage houses, which allows us to buy stocks wherever the volume is in the marketplace. It may not be at your brokerage firm, but it can be elsewhere. So we can go, and it's important in small cap names, to go wherever the volume is.